Welcome back to Bazaar Morning Call. This morning, the GIFT Nifty is indicating a very weak start, and there are a couple of reasons for that. One of them is that global cues have been on the weaker side. The other one is Reliance could be reacting negatively to its numbers, largely because of the oil to chemicals business, which has been weak on account of the weak macro data. So let's talk about Reliance a little bit. The earnings overall have been steady, but it's the oil to chemicals business which is dragged. Otherwise, Jio and the retail business were steady state this time. Let me just take you through the core numbers. As you can see on the screen, revenues up 11.5%. EBITDA barely grew about 1%. The margins have actually fallen to 16.7% versus 18.4% year on year. And the profits were down 5.5% for Reliance Industries on a consolidated basis at 15,138 odd crores. Now, I just want to put the brokerage views on board to tell you what the way forward could look like for the stock. Nomura put out a note where they said that it is an in-line quarter. They reiterated a buy. They've raised their target price to 3,600 on Reliance Industries. Jefferies says that revenues have actually missed street estimates and the subscriber addition has been on the weaker side for Reliance Jio. Macquarie says Q1 was a material miss due to lower than forecasted Jio and the oil to chemicals business, and they continue to see a downside risk to the consensus estimates. They maintain neutral with a 12-month target price of 2,750. Just to reiterate, the oil to chemicals business was weak because of the macro situation, and that was expected. Hence, the stock, after a 15% rally in the last 6 months, could come in for some profit taking today.
Okay, all right. Sonia, thanks a lot for that. Well, let's hop across to Abhishek. He's joining in with the other big number, which is HDFC Bank. Morning, Abhishek.
Morning, Nigel. So, SDFC Bank has beaten our poll with respect to their P&L, both the NI and the PAT. Net interest margin has actually improved by 3 basis points sequentially. Analysts were pegging in net interest margin to remain flat on a sequential basis. So, this is a positive surprise. Operating profits, they are down 18.4% quarter-on-quarter. Remember that in the last quarter, they had an exceptional gain with respect to treasury gains. So, if you remove this treasury gains, operating profit have grown by 9% sequentially. Now, provisions are down 81% quarter-on-quarter and PAT is down 2% sequentially. Asset quality, some deterioration seen over there, but it's largely seasonal in nature given the fact that agri portfolio sees higher NPAs in Q1 of any year for them versus Q4 of the previous fiscal that they have had. So P&L NI is a beat of 0.9% and PAT is a beat of more than 3% for SDFC Bank. Back to you.
All right, Abhishek, thank you very much for that. We'll come back to you for more earnings, but JSW Steel is the next one we want to focus on. Nigel, what do the numbers look like?
Well, that's right. JSW Steel's numbers, they were a little bit disappointing actually. On the top line, though, it was a little bit better. Why is that? Because they've been focusing on their product mix and on VAP. And because of that, on the realizations on a sequential basis were more or less flattish. So that explains why on the top line there was a bit of a beat, though the margins were a little bit lower than what we were working with. Let's break it up into two parts. One is the standalone business. That did well. There was some marginal improvement in the standalone EBITDA per ton on a sequential basis. And on an EBITDA per ton, well, it was a little bit better than what we were working with. So good going on that front. And on a sequential basis, as I mentioned, it moved up by more than 400 rupees. The problem was the international business. The US plate and mill business, out there you saw a contraction in the EBITDA number. Also, the Ohio business, there was a loss, and that loss went up from around 5 million to around 15 million odd. So that was the problem pocket out there. The net debt as well moved up because of the capex that they are incurring, but the management believes that the return ratios will stay constant. So on the back of that margin miss and the pressure we saw in the international business, going with red on this one. In fact, we'll have the management who will be joining us in a short while from now. So remember to tune into that conversation at 9:40 a.m. later today. Let's focus on the other big number, Wipro. Rima, that one's numbers, in fact, were disappointing. And the problem is the stock has seen a big run up to these numbers.
Indeed, and that's the reason why the Wipro ADR was also under immense pressure on Friday. It was down 11%. So Q1 was a miss. On Friday, also stock had, adversely, in anticipation perhaps of weak numbers, it had corrected 2.5%. But still, since the beginning of June, it's up close to about 27%. So Q1 was a miss on revenues and a miss on the next quarter's guidance. Revenues have declined by 1%. This marks the 6th consecutive quarter of a revenue contraction for Wipro. The Q2 guidance is also a miss at -1 to +1%. Morgan Stanley says expect Wipro to continue to lag peers on revenue growth in the near term, which will keep its PE multiple at a discount to peers. They're seeing early signs of a recovery tailwind, but Wipro needs better execution to benefit from there. So, a bit of a run-up in anticipation of a turnaround, but that's not played out, and the stock could be under pressure today.
Okay, thanks a lot for that. Wipro never fails to disappoint, doesn't it? I mean, I don't remember a single quarter when Wipro actually outperformed. Maybe one in the last 10, 15 quarters. But anyway, moving on, Kotak Mahindra Bank, Abhishek is here to tell us how that one looked. Abhishek, over to you.
Well, another disappointment after Wipro, you could call Kotak Mahindra Bank, because the net interest margin has actually declined to an 8-quarter low, despite the fact that their CD ratio or credit to deposit ratio has improved. So operationally, a weak quarter for Kotak Mahindra Bank. Take a look at the net interest margin. It has come in at 5.02%, which is a decline of 26 basis points on a sequential basis and 55 basis points on a YOY basis. So deposit growth is at 15.8% YOY and decline of 0.3% sequentially. YOY is the lowest growth that you are seeing in last 6 quarters, and for the first time in 16 quarters, the deposits have declined on a sequential basis. Now, advances growth was healthy at 18.7% YOY. It's the best growth that you are seeing in last 6 quarters for them. Operating profit grew by just 6% YOY and it declined by 3.8% sequentially. So the 6% growth rate of operating profit is one of the weakest in last 6 quarters or 8 quarters. Provisions that have increased sharply by 59% on a YOY basis and about 119% on a sequential basis. So P&L, the NI is a miss on our poll. However, on account of the one-time exceptional income that they have had through stake sale of general insurance business, the PAT has come in at 6,250 crore. We are working with a number of 4,000 crore. Back to you.
All right, Abhishek, thanks very much for that. JSW Energy is the next one we want to focus on. Vivek has got details. Vivek, morning.
Well, good morning. So JSW Energy came out with a good set of results. Operationally strong quarter, largely aided by generation volumes higher by almost 18% on a year-on-year basis. However, one thing to keep in mind is that amongst the entire power universe, this particular stock trades at a steep valuation, and that's something that brokerages have highlighted. Now, talking about what impacted the quarter in terms of even operationally, Vijayanagar and Barmer plants saw slightly lower utilization on the back of planned outages. Profits were aided by lower net interest costs and depreciation, and also aided by the QIP fundraise. Now, talking about the actual numbers themselves, revenues down by close to 2% on a year-on-year basis, coming in close to the 2,880 crore mark. EBITDA higher by 16%, coming in close to the 1,418 crore mark. Margins are expanding quite significantly on a year-on-year basis, coming in at 49.2% versus 41.7%. Profitability higher by 80% on back of the factors that I just mentioned, coming in close to the 522 crore mark. Now, talking about the plant availability factor, continue to stay above the normative PAF of almost 102% that we saw in the same quarter last year. Interesting to see, expect some green on the stock at the opening. Interesting to see whether it sustains.
Thanks a lot for that, Vivek. In fact, we'll have the management joining us at noon later today to give us an insight about the last quarter's numbers as well as the way ahead. But let's hop across to Mangalam. He's here to tell us about Indian hotels. Hey, Mangalam, morning.
Good morning. So it was a seasonally weak quarter for the hotel industry itself. So in that light, Indian hotels also performance was largely soft, but that's something that the street was anticipating already. Why is that? Because there was the election, so government-related business didn't come by. There was the heat wave, and there were 25% lower wedding dates as well, as a result of which there was lower wedding revenue too. So 5.7% growth in the overall revenue of the company. The EBITDA grew by just about 10%, and the net profit grew by 12% as well. If you look at the occupancy during this quarter, it was up 1%. The domestic average room rate was up around 2% as well. So in a seasonally weak quarter, the company was fairly resilient. They've continued to maintain their double-digit revenue growth guidance for the full year. So see mild red on the stock, and chances are that maybe if the market recovers, then we could see some recovery on Indian hotels as well.
Okay, all right. Mangalam, thanks a lot for that. Well, I'm looking at JK Cement and I'm expecting the stock to react favorably to its numbers. Let's run you through the data points then. Top line, there was a bit of a growth of around 2%, though realizations remain under pressure because the volume growth was at around 6%. The EBITDA number, that jumped up by close to 19% on a year-on-year basis, and margins improved as well on a year-to-year basis. Comes on a lower base, but these numbers look good. There were two key factors out there, and this is a cost-focus driven beat, because the power and fuel costs were down sharply, and the other expenditure when you have volume growth of around 6% and the other expenditure goes up by only around 1%, that helps you in terms of operating leverage as well. The net debt, yes, it's moved up marginally, but that's par for the course because the company is at a capacity of around 24 million tons odd, and they've already outlined that in the next 2 years, they'll move to around 30 million tons odd. So expecting the stock to open up in the green. That's about JK Cement, but let's wind this down with Mangalam, who's here to tell us about Patanjali Foods. Mangalam.
Well, looking good for Patanjali Foods, largely because the edible oil cycle is turning in the company's favor. So to that extent, I'll watch out for any sort of reaction, even on Adani Wilmar. So revenues for the company were down about 7.6%. That's largely because, they've taken price cuts on lower oil prices, but gross margins have improved. The EBITDA has actually jumped 140%. And on the back of that, the net profits nearly tripled from 88 crores to about 263 crores. So the edible oil segment, which was an EBIT loss-making segment same time last year to the tune of almost 150 crores, has made an EBIT profit of close to around 200 crores as well. The FMCG business, the revenues were flat out there. The EBITDA was down by almost 50%, but that's largely because the company spent more on ads during the IPL. So we'll get more detail on this business going forward. The key to track for Patanjali Foods now is the growth through acquired personal care and home care businesses of Patanjali Ayurved, the announcement that they made earlier this month itself. So to that extent, see a lot of green on Patanjali Foods.
Okay, well, let's go across to Abhishek to catch up on Poonawalla FinCorp and how that one looked. Abhishek, over to you.
Well, seasonal impact did have, on the disbursements of Poonawalla FinCorp. Disbursements are up just for 4.8% YOY and they have declined by 23.6% sequentially. However, the AUM growth remains strong. AUM growth is at 51.7% YOY and about 7.9% sequentially. Now, calculation shows that the net interest margin might have contracted by 45 basis points on a sequential basis, which is, a disheartening point to see that NBFCs are losing on net interest margin. Other income was up robustly, which helped the overall net income for the entity. Now, the PAT is down about 12% quarter on quarter because they made provisions with respect to, writing down the asset quality or writing off the gross NPA. So, look at the asset quality. Gross NPA ratio has improved to 0.67% versus 1.16% in the previous quarter. Net NPA ratio has improved to 0.32% versus 0.59% in the previous quarter. So, asset quality improvement may go down well with investors today. Back to you.
Okay, thanks a lot for that. Here's a quick recap of our top stocks with positive news flow: HDFC Bank, JSW Energy, Patanjali Foods, Poonawalla FinCorp and JK Cement. While many large caps with negative news flow: Reliance Industries, Wipro, JSW Steel, Kotak Mahindra Bank and Indian Hotels. But let's also get a quick roundup of what's been happening in the world of commodities. There is so much that's happening across the world that, of course, it has ramifications on the commodities as well. Manisha Gupta is joining in. Manisha, hi, good morning.
Morning. Absolutely, Sonia. There's just plenty happening in commodities as well. If you look at the crude oil prices, we are now trading at around 5-week lows after 3.5% of decline in the previous week, which, by the way, was a second weekly decline. We have started this week on a weaker note as well. Well, the strength in US dollar, the weak China economic data, and the markets are now reacting to the China rate cuts that we have seen coming in. Well, this is to record lows that we've seen the LPR rates being cut to. The one-year loan prime rate has been cut by 10 basis points, and there also is a 7-day reverse repo rate, which has been declined to 1.7%. Some minor support in metals is what I'm looking at right now after that very sharp decline in the previous week. But since the China plenum meeting ended without anything, this is what perhaps could lead to some support coming in for the metal prices. When it comes to precious metals, well, the US dollar strength, the strong US jobless claims data, and the US Fed meeting on July 30th and 31st, ahead of that, we have seen declines coming for this one. So gold is trading at a 2-week low, silver at a 4-week lows, aluminum still holding around those 3-month lows. The markets are still reading into the China rate cut, and some reactions are anticipated during the day.
All right, Manager, thank you very much for that. So that's basically what's happening as far as commodities are concerned. Gold in focus. Prakash Diwan is going to be joining us with some fundamental stock talk. Stay tuned. That's coming up.